Welcome back. You're with us on Corporate Radar. Let's move on and talk about our the next stock that's on our radar. And that is Ramkrishna Forgings. The company is looking to raise up to 1,000 crore rupees via a QIP. The board has given its approval for conversion of 46 lakh warrants into equity shares as well. Do note that the stock is up over 200% in the last 1 year, so it's been quite the mover. To talk about all the plans ahead, we have Naresh Jalan, Managing Director of Ramkrishna Forgings with us now. Mr. Jalan, thanks for joining in. So first things first, 1,000 crores via a QIP. What's the timeline that you're looking at, and why do you want to raise this amount of equity?
Good morning. I think right now we have just taken an enabling resolution. So I think we don't have a timeline. It's valid for 365 days. So basically we have taken this resolution looking into the market and the availability of because of a lot of consolidation happening in the forging industry. So we feel that there are a lot of opportunities which we are facing with. And if there is a right opportunity and right segment where we can spend money, so that's the reason we have taken this enabling resolution. So we can go to the capital markets and get funds in case of any new opportunities which arise with us.
So, Mr. Jalan, since you're already looking at shoring up the purse, I'm guessing there's something interesting on the radar that you've already noticed in terms of acquisition?
No, I don't. Nothing is there in the pipeline yet, but we are regularly getting a lot of opportunities, I think, both organic and inorganic both. So I think as a prudent management, we think that we should be ready with the purse. Whenever there is an opportunity, we can go ahead and do the deal.
Mr. Jalan, whose purse is feeling very, very good will be your shareholders, because you have delivered and delivered in style. The stock, has re-rated big time in the last 12 months. So good for your shareholders. But what you do from here on is going to be important. So give us some clarification. You're talking about inorganic growth, organic growth, and there's a third aspect, which is debt. So if you happen to go ahead with this QIP, how will you split it up between utilization of the funds? Will it be purely for organic or inorganic growth? Or is there a possibility that you look to reduce debt?
No, I think we have reiterated in our earlier calls and conversations that we would like to we don't want to be a zero debt company. We can live with small debt. Debt to EBITDA as planned is 1:1 or below 1. So I think right now in course of business, whatever we are doing, I think within a year or so, we will be below that. So obviously this purse right now will be utilized obviously to pay off the debt, but we will be ready with this cash for organic and inorganic growth, both as an opportunity arises.
Mr. Jalan, I think you'd said that debt should be down to between 150 odd crores by the end of the year. That's the plan?
Yes, that's the plan.
Okay. Now, you were also in the process of raising capacity to 2.4 lakh tons by the end of September. We're talking to you.
I think by this year end, by FY24 end, we should be close to 260,000 tons of available capacity.
What's the capacity now?
It's close to 230,000 tons, and I think by the end of the year, it should be 260.
Okay. You told us that the out of the capacity, but I think the numbers are now different. So what would you sell in terms of volumes this year in FY24?
I think vis-a-vis whatever last year we did, we are looking at a volume, as we guided earlier, we are looking at a 15 to 20% volume growth for the full year. From the organic, and whatever we have acquired, I think that's going to take shape in the last quarter of this year. So we'll still have some time before we can commit on the acquisitions which we have done. So what volumes can come out of that?
Mr. Jalan, earlier you had told us that the share of the non-auto business for Ramkrishna Forgings, that will keep growing. And I think you had given a guidance that it will move up to 30% of your business. Now, I just want to understand what's happening here, because you also have a tie-up with Titagarh Rail on, I think, over 15 lakh forged wheels that you have to deliver for the railways. That's a long contract, right? It's a 20-year contract. So is that included in this guidance that you gave? If you could just throw some more light on the non-auto business and what's the scale-up plan? And also what that means in terms of margins.
Non-auto business itself is doing extremely well for standalone RKFL, and RKFL Titagarh JV business is nowhere linked to this 30-70 ratio which we are talking about, 70% auto and 30% non-auto. 30% non-auto will be RKFL on a standalone basis will be able to achieve by next year, and we are on track of it. You will be able to see in the next three results, half-year results as well as the next two results which are going to come out. We are scaling the non-auto operations exceptionally well, and we are on track to achieve that. And Titagarh Railway JV is going to come in place by 26 first half. So I think it's still a long time to go before that comes into place.
Okay, got that. So since in any case, I mean, on your own, Ramakrishna is going to move towards 30% non-auto, what does that mean for margins? I'm just trying to understand between both the segments, if there is a margin differential, a sizable one.
No, I think in overall context of RKFL's on standalone basis, we are on an aspirational basis, we are looking at least 100 to 150 basis points improvement in margins in the next 2 years' time. That is the aspiration we are working with. I think while we sustain the current levels of margin, we aspire to improve the margins by 100 to 150 basis points in next 2 years.
Okay, all right. Mr. Jalan, we'll leave it there. Good speaking with you, sir. Thank you very much for your time. And it's a pleasure. Good luck. Well, that's Ramkrishna Forgings. Stock's done very, very well over the last quarter, and expectations are running high.